Good evening. My name is Peter Resnichek from ShadowTrader.net, and this is another edition of the ShadowTrader Video Weekly for Sunday, April 19th, 2020. How to change your trading life. That is the title of this video, and it is what I hope to do for you over the next 10 to 15 minutes. I'm continually inundated with emails, especially recently, of people asking me where they should be shorting this market, or they've gotten short this market and they're really kind of in a pickle and they're asking for my help. And if you go back over the last 3 videos that I've delivered to you, you'll notice that there's a common theme where basically I've been trying to get people to think more objectively and deal with what's going on right in front of them rather than be following the news flow. The news flow continues to be continually bearish, and yet the market has been rising for quite some time now. So in this particular video, we're going to talk about a number of nuances that I want you to pay attention to that will help you to be more objective, and also tell you what I think is the #1 thing that traders need to do in order to view the markets correctly and have that level of objectivity that they need to make money consistently. All right, without further ado, let's get into it. So let's begin on market profile this week. But before I start the analysis, I want to talk a little bit about my last 3 videos because I really feel that they were spot on. And that's kind of the whole tone of this particular video, is not just to say, I was right or whatever. It's the fact that I continue to get lots of emails from people that are obviously very, very focused on what's going on just with the coronavirus and all of the fundamental type of news that's coming at us in the current news cycle. And I generally tend to ignore all of that. Those of you who have been fans of my work for some time will note that I really never speak of that stuff. I maybe a little here and there, but generally you don't hear that stuff coming out of my mouth. And the reason for that is that I really don't care. I really don't pay attention to it. I trade full time, but I almost never have my television set on during the day as I'm trading. I don't have CNBC on. I don't have Bloomberg on. Maybe sometimes I'll have it on with the sound off just so I can maybe see a chyron at the bottom of the screen, maybe like on a Fed day or something like that, just so I can see to make sure that they didn't raise rates or lower rates or whatever. And in the evenings as well. Don't watch Mad Money. Don't watch, any financial media in the evenings. I really don't pay any attention to it. And I'm talking to you in this video here to tell you that I really think you'll be a far better trader if you didn't pay attention to it either. But you can't just trade in a vacuum. You have to have something guiding you. And for me, that's always been technical analysis. I'm a dyed-in-the-wool chartist. I always have been. And I hope that I've showed you a little bit in all of these videos how if you just stick to the charts, then you're going to be so much more objective because you're going to be looking at things as they really are and not as they might be because some outside catalyst that you think is going to have influence on the market, after you enter your position. The problem with that is that those catalysts are often very, very ill-timed. You do not get movement right when it happens. The market is generally ahead of things. You can see now that the coronavirus cases have not peaked at all. We have not flattened the curve, actually. If you look on the Johns Hopkins tracker website, it's still rising up like this. It's still going in the same trajectory, and yet the market's been rising for quite a while now. So you see the market seems to be always ahead of things. There's always this huge disconnect in terms of timing. And the other thing is that because the market is 100% driven solely by the inventory position of the players involved and whether or not they need to close those positions or add to those positions in the context of a very large two-way auction, okay? The news is actually often wrong when it comes out, right? How many times have you seen that a stock will report very, very good earnings and then fall hard? Potentially because the stock was already up for 3 weeks straight up into the number, and it's buy the rumor, sell the news. It's always things like that. There's always this, a lot of times, disconnect. So in this video, I'm going to point out a lot of the nuances that I'm looking at currently just in recent trade. I don't want to go back too much to old stuff back 3 weeks. I do invite you all to find those videos. I do these videos every week. And again, remember, if you want to just search on YouTube, they were called When What Should Happen Doesn't Part 1, When What Should Happen Doesn't Part 2, and then last week, It's Now or Never for the Sellers, which brings us into this week. And again, as I was saying, I wanted to start just on the profile so that I could point out some of these when what should happen doesn't, quote unquote, moments that continue to happen. And when I say what should happen, I'm basically saying that for all intents and purposes, the market should be selling off more, especially here at these junctures where we've bounced to key resistance of 50% Fibonacci's, 61.8% Fibonacci's, and 50-period moving averages, and also 20-period moving averages. But none of this has resulted in bringing in any sort of stronger sellers to this market. And again, when what should happen doesn't, the opposite is going to occur. All right. So here we are with the market profile at the close of business on Friday. The first thing I wanted to point out to you, which is really, really fascinating, is that this day was kind of special in that it had this very large gap overnight, and I called it the overnight gap because it was actually a gap like within the overnight session, right? Those of you that aren't totally familiar with how futures work, you should know that there is something called the maintenance session, which was here when the futures were closed, and then they opened so much higher. This is every day. There's like an hour that they call the maintenance time where the futures are actually closed in the very late afternoon. And when they reopened, there was news on Thursday that Gilead Sciences had some breakthrough, that they were, catching some traction with a drug for the coronavirus, and you can see the market liked that very much, and we opened up much higher. But there were a lot of things going on here technically, or I should say, in terms of market profile, that are so important in the context of the whole when what should happen doesn't, right? So for instance, we opened up on a huge gap, or I should say we had this huge gap higher overnight between Thursday and Friday. This area here has absolutely positively no support. It's like a void. It's like it didn't even exist. And this high here is very, very important as well, because it is the 414 high, which was the prior swing high. So think about this for a second. You obviously get some long liquidation early, and that's typical, that's normal. That's basically the market doing exactly what it should. Short-term traders, if you recall, will get rid of overnight positions very, very quickly, whereas longer-term traders will only be active in the day session. So I wasn't really all that surprised about early selling in the market, because simply it had to be done, right? It had to be done. You had to get rid of all of this overnight inventory that was a 100% net long, so you sold off. But here's where things get really interesting, and this is really the crux of how I look at market profile and how I look at the markets. If you come into the markets knowing that the short-term traders are going to do a certain thing, which generally is to fade the market. When the gap is very large, the general MO is for the short-term traders to fade the market and rebalance some of that overnight inventory, which makes perfect sense because those overnight players tend to be weak hands. So when you see this inventory balancing happen, the first thing you should always be thinking of is, what are the signposts where the market should be going, so you can play it directionally on the fade, right? I always talk about that in my pre-market perspective report as days that you have potential to trade early versus days that you have potential to trade later, meaning that the early potential is not there because there's no shock and awe. But on a very large gap, there is huge shock and awe. So the first thing you want to look at is just very simply, okay, where's my prior day's RTH high, right? Which is going to tell me basically where could I go, right? The prior day's RTH high is always very, very important. So where could I go? So this is my full gap fill here. And you can see Window Trader puts these arrows in between where the gap remains unfilled. So right off the bat, here's a classic when what should happen doesn't moment. This is a fantastic piece of information to carry forward into your narrative to give you a better idea of what's happening in the bigger picture. Basically, the gap didn't fill. Again, when what should happen doesn't. What should have happened is all of this overnight inventory that was 100% net long should have drilled all the way down into here and filled the gap, but it did not. So that's point one. You have a huge piece of information. Then, second piece of information, as the market is selling off, as the market is selling off during the course of the day, not only does it stop, and this is interesting, it kind of stopped here at a prior value area, but because it's an older day, it doesn't mean that much. But not only did the gap not fill, but what was noteworthy was that this was the prior swing high, which was the highest point in the market of the recent rally. The overnight activity opened above it and then had the liquidation break, which it should have, and then did what? Found its footing where? In the exact same place in terms of value as the last highest day we had in the market, which was April 14th. That's very, very interesting to me because think about it. If sellers were going to come into a market at highs, why would value be unchanged? If there's sellers coming in, right? Think about it. Value needs to get lower. Value and price are often disconnected, and price can often give you very, very pinpointed entry points. You can use price for entry points, and that's great. That's what you should be doing because you're looking at, for instance, very high prices right up against a certain key resistance or a very key level, and that price will tell you where you need to enter. But I will tell you this, if you don't have value following behind you, price will probably very quickly return to where you shorted from. You're not going to get any bang for your buck. You're just not going to catch traction. So this is yet another thing that I'm carrying forward into next week is that A, the gap didn't fill, B, value was unchanged. So let's talk about C now. Again, to carry forward, you have this 414 high. And where did the market close? All the way up here. So the market actually closed higher than it did than that swing high. And a lot of people might think about this or hear this commentary and they think, oh, well, that's just kind of simple. But you'd be surprised how many people actually don't think of the simple fact of thinking of prior days highs and lows of what is referred to as O, H, L, and C, right? Open, high, low, close. These are the most important pieces of data around. I can't tell you how many times I've gotten emails from people who watch my videos or whatever, and they're very, very bearish in an uptrend. And they're, it's almost like they're sending me an email telling, trying to get me to short it with them, which I have no interest in. And they are not paying attention to, nuances. Like they'll say, for instance, that I shorted today and I think it's going to be great. I think I'm right near the top. And the next day, or even within that session, I will notice that there was a reversal day, for instance, that day. Maybe there was some good trade location for a short, and yet the prior day's low was not taken out, and you didn't even get below, for instance, the point of control of the prior day's session, meaning where the most volume traded in the prior day's session, the session that's the supposedly great short opportunity actually closed above that, right? It's things like this, little nuances like that. I mean, that's a little bit more granular when you start to get deeper into market profile. But if you can just use the simple facts of open, high, low, close and judge every single day according to whether or not the bulls won it or the bears won it, right? Sometimes people call that bar by bar analysis. Are you taking out the prior day's high? Did you close above the prior day's high? Did you just remain in range like this, right? Did you go below the prior day's low? Were you able to close below the prior day's low, right? So where did you open? How high or low did you trade? And where did you close? These things are very, very important. I firmly believe that if people would just focus on just that, literally just what I just said, just on the OHLCs every single day, and at the same time turn off all financial media, except for ShadowTrader Squawk Box on the Thinkorswim platform, of course, but turn off all financial media for a month, you would see that you would understand the markets so much better. Everything would be clearer and it would be so much more objective. Okay, so now we've switched our chart to a more technical analysis view of candlestick charts as opposed to the market profile that we were looking at before. And here's where we can really see a lot of the recent technical events that I've been talking about that have set up this whole when what should happen doesn't, or it's now or never for the sellers. If you recall in last week's video, I clearly talked about the fact that if the market was going to move lower, it would make sense to me that the sellers should get active here at the 50% Fibonacci retracement of this entire move from the high to the coronavirus low. Well, guess what? If you look at the last 5 trading days, correct, which would be these, how did the market resolve that 50? I mean, did you actually get any selling pressure at that halfway point? You did not. So again, these are the things that you would want to be looking for as opposed to be looking to the news media or what's going on in the world to tell you what the market is going to do. The market is telling you what it's doing, right? That stuff that's going on in the news, as horrible as it is, okay, that's not telling you what the market is doing because the market is obviously doing whatever it's doing on its own, okay? So you have to pay very, very close attention to that. So beyond that, the 50% fib level was not, did not bring in any sellers, as we know. And what happened then is I was telling you last week that we have the 50 MA above us, and then we've got the 61.8 looming above us. Well, look what happened in Friday's trade. First of all, when we got up above the 50, it took a couple of days to resolve it, and yet the lowest day was this one after touching the first one, and then you spent all these 4 sessions either at it or above. And then on Friday, what happens? Not only do you touch the 50 MA, but you actually breach it over. So I mean, there was a little bit of resistance early on in the session on Friday. If you want to talk about where the market faded initially from the highs, it was actually very, very close to that 50-period moving average, which made perfect sense early. Like I said, you had overnight inventory 100% net long, especially with that huge like overnight gap where the futures opened, then closed, then opened again even higher and kept going, right? All of that needed to correct. But when it corrected, did any longer term new money sellers come into the market? Obviously they did not, because the market closed on its highs, all right? So looking forward, what does this leave the door open for? Potentially the 61.8, right? More than likely, the market wants to at least see the 61.8 in this coming week. And if we switch to the NDX, right, this is where things get really bullish in terms of all of the technical events that have transpired, correct? Because again, look at, here's your, and I apologize, I don't have my screen draw turned on. That's why I'm kind of going back and forth looking at the other screen. Look at the resolvement here of the 50% level. Then you have no even touch of the 50. It doesn't even touch it because it gaps over it and then just keeps trading higher right from there. Mostly on the heels of what we saw with Amazon, Netflix, etc. this past week. So that 50 MA didn't even come into play in the NDX, and we just went way above it. Do you understand that just that one small piece of information, like let's say you were strictly holding only stocks that trade on the New York Stock Exchange and you're worried about them, or whatever, or you feel that it's short or whatever. Do you see how intermarket analysis of just looking at very simply other indices to see what they're doing is going to give you a lot of information about how the S&P is acting? The S&P and the NASDAQ can easily have a slight disconnect every day in terms of relative strength and relative weakness, but you're not going to get them moving in opposite directions. All right, keep that in mind. It's very, very important. The NASDAQ showed extreme relative strength for most of this week, but if it was a green day in the NASDAQ, it pulled the S&P with it. They're not going to absolutely completely disconnect where the chart pattern is going to be different, where the SPX is going to be going down and the NDX is going to be going up. That's not happening. So if you would just pay attention, for instance, to what the NASDAQ is doing, acting as a leader, it would give you huge information on the S&P. And those of you that have been very bearish, for instance, this week and potentially got run over, you wouldn't be as bearish. You would say to yourself, wow, okay, well, yeah, I mean, the S&P may be having some trouble resolving that 50% fib, but I checked out the NASDAQ 100 and like, wow, I mean, it closed the bar way above the 50, and then it gapped above the 50%, and then it gapped above the 50 MA, and it just kept going. And then when it came to the 61.8% retracement of the whole move, where it really should have stopped, not only did it not stop, but it closed way above the 61.8 on that day and then continued higher. So do you see how this is like, when you put it all together, what I'm trying to get to is this is the type of simple information that you need to be looking for, and that's what's going to keep you objective. As I said in the title of the video, how to change your trading life. This is how I really feel that you can change your trading life by just looking at very, very simple things that will keep you objective and stay away from the stuff that really doesn't have that much to do with the market. It may seem that way on the surface, but remember, because that timing issue is so disconnected, it's very, very hard to trade, off of fundamentals in that particular fashion. Okay, and last but not least, let's look ahead now. What am I going to be looking for next week? Well, the first place my focus is going to be is where the action is, which seems to be all in the FANG stocks: Facebook, Apple, Amazon, Netflix, and Google. They're the ones that seem to be leading the market up out of this. They're all coming up onto Q1 earnings, so that kind of makes sense because these stocks are usually hot ahead of Q1. So I thought we'd just look at some of these patterns quickly. And you can see, for instance, Apple has a very nice small balance area here. I would potentially be interested long on a break there. Notice that it completely has resolved the 50 MA. I shouldn't say completely, but it feels like the price action is above the 50 MA, so you should potentially see higher there. Facebook is actually not as strong. It's still holding under the 50. I would probably leave that one alone. Amazon is absolutely on fire, and any pullback is probably buyable in the stock. Friday, there was a minor pullback, I would say, came into here and didn't really materialize, so keep an eye on that one. More than likely, the thing that's tricky with Amazon is because the earnings are coming up relatively soon, they're on the 23rd, you can't really do a risk reversal in terms of selling puts and buying calls. You just have to buy the short-term calls and then potentially be out of the calls by Thursday evening because of those earnings coming up. Or if you're a gambler, be my guest, stay with the calls on earnings. Netflix was also very hot. They are going to report also relatively soon, which is on 4/21. That's coming up soon. So probably nothing to do there on the options. Let's just keep going through. Google, as I call it, also having a little bit of trouble, but they are not reporting until 4/28. So you do have one more options expiry of the April 24th to potentially play around with. But remember, it's going to be somewhat sensitive to what the other ones do. So when Amazon reports on the 23rd, there could be, some movement, obviously, in Google. All right, beyond that, I am continuing to watch gold and crude oil. Gold, I do think, is a pullback here to the 50 MA, which would make sense. I would like to be selling puts and buying calls in gold, doing a risk reversal in the coming weeks. And last but not least, CL, which I've been talking about, is finally deep into the teens. I believe that it just had a contract rollover, so you need to look at K20. Look at that. This is the one that is the front month, and look at where the close was today. $17.31 per barrel, right? And again, if you recall, actually it's not going to show up on this one. I have to do continuous contract for that. But there's my monthly continuous contract, and this is that $17 low area that I was talking about. As I was saying, I would be interested in accumulating some crude contracts at those lower levels. I already talked about that in prior videos, and also in prior videos I gave you the two ETFs that I would be more than likely looking at, and I have them written down here because I don't trade them that often. That is on my blotter, DBO and USL. They are the more long-term ETFs in terms of holding longer-term crude contracts, which I feel would probably be better if you want to hold this for a little while. If it's more of just a quick pop on something that's tracking the near-term crude contract, then obviously that would be USO. All right, potential that this could easily go lower. Look, notice the double bottom support here, 100% retracement to there. So obviously it's going to track the price of crude, and we know where that seems to be going lower at this juncture. And that's all for this week. Thank you, as always, for spending just a little bit of your weekend with me. So let's just recap a couple of things that we discussed in the video. From a purely technical level, we know the NASDAQ is on fire and it's pulling the S&P with it. We're in the heart of earnings season, not really in the middle of it yet, but it's starting to heat up. So that's obviously going to be in play this week. Watch those FANG names that I talked about, all right? Beyond that, think about potentially having a news detox. Try it. See if you trade better. Don't pay any attention to any financial media for an entire month and just look at charts and remember those nuances that I talked about. Opens, highs, lows, closes. Stick exactly to what is. You'll maintain a high level of objectivity, and I do believe you'll be a much better trader. If you're interested in getting more guidance from me on a more real-time basis, check out the link below, shadowtrader.net/options, and look for the weekly options advisory or the time spreads advisory run by my colleague Scott Gillum. Both of them include my What's Peter Thinking messages live in real time via text, along with options trades also live in real time via text, and included is my free market profile report, Peter's PreMarket Perspective. On behalf of myself and the entire ShadowTrader team here in beautiful Philadelphia, Pennsylvania, I wish you good trading and good night.